Good morning, venture capital. This is Metagame, and today we're tracking why one corner of SaaS just survived the bloodbath, and the numbers don't lie. While you were tracking the megarounds, vertical SaaS quietly won a war nobody was covering. That's not a prediction. That's a verdict. And the evidence is sitting in public market pricing data, private deal flow, and enterprise procurement behavior, all moving in the same direction, all at the same time. The question is whether you're reading it. Let's start with a number. 38 points. That is the multiple spread between horizontal SaaS and vertical SaaS over the last 12 months. Horizontal down 35%, vertical up 3%. On its face, 3% sounds like nothing. In context, it's the difference between a category that's being repriced out of relevance and one that's quietly holding its ground while everything around it burns. 38 points isn't noise. That's a structural rotation, and it's already showing up in your portfolio whether you've named it yet or not. Here's the mechanism. Horizontal SaaS, generic CRM layers, broad productivity tools, seat-based collaboration software built its entire valuation case on two pillars: switching costs and network effects. The pitch was always, once they're in, they stay in. And for a decade, that was mostly true. Then AI arrived and started dissolving both pillars simultaneously. Enterprise buyers are now negotiating opt-out clauses into SaaS contracts, flexible terms, exit provisions, shorter commitment windows. When the lock-in thesis softens, the multiple follows. That's not a theory. That's the math. And it accelerates. The entire industry is moving toward usage-based pricing, metered AI billing, task-level measurement, consumption models, Anthropic, Salesforce, ServiceNow, Workday, all of them shifting away from seat counts. Seat counts were the revenue engine of horizontal SaaS. When the billing model migrates to task output, every vendor that can't demonstrate measurable workflow impact loses its pricing anchor. Every horizontal SaaS company repitching itself as AI-enabled without owning a specific workflow is staring at this compression and calling it temporary. The data says structural. Now flip it. Why did vertical hold? Vertical SaaS doesn't rely on the same lock-in architecture. It owns something different: proprietary industry data, regulatory workflow context, operational processes that AI can't replicate without domain-specific training. When the market started repricing toward output measurable software, vertical tools had a structural advantage. The workflow and the data model are co-designed. They're the same thing. You can't extract one without the other. That's not a feature. That's a moat. Snowflake's stock move is the public market proof of concept, up 35% in a single week on AI product adoption news. Not a generic AI hype move, a platform with specific, demonstrable workflow pull-through getting repriced in real time. The market isn't anti-software, it's anti-generic. Snowflake showed measurable output. The market responded accordingly. That's the template. Now let me explain something directly, because this is where people get confused. When you hear vertical SaaS, the instinct is to think small, niche, limited, TAM. That framing is wrong, and it's costing allocators real money right now. The MGV thesis puts it cleanly. Find the specific industry workflow that's still manual or stitched together with spreadsheets in 2026. Build the AI native solution. That's not a pitch deck line. That's an underwriting framework. The unit of specificity that earns the multiple premium isn't a feature set or a model integration or a copilot layer bolted onto existing software. It's a workflow, one workflow, in one industry, owned completely. Back to the story. Two deals from this quarter illustrate exactly what that looks like in practice. Manifest OS, legal AI, $60 million Series A, $750 million valuation. Built around a narrow, regulated, document-intensive workflow that law firms are still running on email and spreadsheets today. Grid Care, $64 million Series A, targeting idle power grid capacity identification. A specific operational problem with a specific data model and a specific buyer. Neither of these is a horizontal play. Both cleared Series A at $50 to $75 million with identifiable category-defining momentum. Both fit the framework precisely. And they're not anomalies. 174 sub-$500 million technology deals filed with the SEC in Q1 alone, median deal size of $27.6 million. The app layer isn't dead. It just stopped rewarding horizontal thinking. Deal count fell about 12% from Q4 to Q1, but capital at the non-mega tier is up over 14% in the same window. Fewer deals, bigger checks, higher conviction. That's a market narrowing toward category bets. And the category winning is the one with depth, not breadth. Here's where the AI concentration story connects. Anthropic and OpenAI captured 89% of tracked AI startup revenues as of the end of last month. Foundation model value is concentrating hard at the infrastructure layer. That leaves 11% of the AI revenue stack in play at the application layer. 11% of a very large number is still a large number, and vertical SaaS is better positioned to capture it than any horizontal wrapper because it controls the domain-specific data and workflow context the models actually need to be useful. The enterprise ROI problem reinforces this. 95% of AI pilots fail. Generic coding tools aren't producing the productivity gains buyers were promised. Enterprise procurement is tightening. Buyers are pushing for measurable outcomes and negotiating escape hatches on contracts they're uncertain about. The products that survive that scrutiny are the ones tied to a specific operational result, a specific output, a specific workflow, a specific data model. That's vertical AI's structural edge in the current procurement environment, not because it's more exciting, because it can prove it works. So what does this mean for how you're positioned right now? If 65% of Q1's total venture capital went to 4 companies, the remaining 35% is competing for the non-mega market. Within that market, the 38-point multiple spread is the most important pricing signal in application layer software right now. Any fund still writing horizontal SaaS checks without a specific AI workflow thesis isn't just underperforming. It's writing into a depreciating multiple environment with weakening lock-in dynamics and a buyer base that's actively renegotiating contracts. That's a 3-sided problem. Multiple compression, churn acceleration, and a billing model migration all hitting simultaneously. The opt-out clause wave is the piece that doesn't get enough attention. When large enterprise buyers are renegotiating contracts with exit provisions across the software stack, the renewal rate assumptions embedded in horizontal SaaS valuations are at risk, not theoretically, practically. If your portfolio has generic productivity, broad workflow automation, or collaboration tools that don't own a specific industry data model, those marks are exposed. The question isn't whether the pressure is coming, it's whether you've stress-tested the renewal assumptions before the next board meeting does it for you. The opportunity side is equally specific. Regulated industries with document-heavy, spreadsheet-dependent workflows, legal, energy operations, financial services, healthcare compliance, any sector where regulatory context and proprietary data create natural moats around the workflow. Series A rounds in this cohort are clearing $50 to $75 million with real category momentum behind them. The domain-specific data moat, combined with usage-based pricing that ties revenue to task output rather than seat count, is the defensible architecture for the next multiple expansion cycle. That's not speculation. That's what the current pricing data is already rewarding. The mega-round game is about scale, $100 billion valuations, sovereign wealth participation, infrastructure bets that require a specific fund size and a specific risk profile. That's one sport. The Series A and B game right now is about depth, one workflow, one industry, one operational choke point that no incumbent built correctly. Different sport, different scoreboard. And here's where the open loop closes. While everyone was tracking the mega rounds, the $122 billion OpenAI raise, the 4-company concentration story, the infrastructure CapEx numbers that sound like GDP figures, the actual rotation in software multiples was happening underneath all of it. Quiet, structural, measurable, horizontal down 35%, vertical up 38 points of spread that is now showing up in public market pricing, private deal flow, and enterprise procurement behavior simultaneously. The market isn't confused. It's not transitioning. It already decided. The team's chasing depth in a single regulated workflow, a single data-dense industry, a single operational choke point. Those are the ones the multiples are rewarding. The teams still pitching broad horizontal productivity in 2026 are holding a depreciating asset and waiting for a reprieve that the data says isn't coming. Find the workflow that's still running on spreadsheets in 2026. That's your term sheet. Which deck are you holding? That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.